Hi, everyone. Welcome and thank you for joining us today for our webinar. We're so excited to have you here, whether you're joining us live or watching the replay. My name is Shannon Galladay, and I will introduce our speakers today and run the Q&A at the end. We are so excited to have a lively, myth-busting conversation about Trump's One Big Beautiful Bill. So this is part two of the conversation. If you joined us before and you haven't seen or you have seen the replay, get excited because we are going to continue the conversation. Our conversation will be about 40 minutes long. We'll leave space at the end for your questions, so feel free to drop those in the Q&A box as we go. So I'm so excited to first introduce Jenny Groberg. She is a wife, a mother, a champion of women, and the visionary CEO and founder of BookSmarts Accounting and Bookkeeping. Committed to empowering women at every stage, every life stage, she has brought together a dynamic all-female team offering a fully customizable suite of services that give clients full confidence in their financial data. Jenny's work has been recognized internationally with 4 Stevie Awards as one of Utah's top 100 companies dedicated to championing women, Utah Business CEO of the Year, and most recently when she was named the prestigious Inc. Female Founders 500. Jenny's financial expertise has been cited in Forbes, Wall Street Journal, Inc., Accounting Today, NASDAQ, Yahoo Finance, Entrepreneur, U.S. News World Report, and more. Jenny holds a degree in finance from the University of Utah. So welcome, Jenny. Excited to see you
Thank
here.
you.
Sure.
Thank
So joining Jenny is Kelly Phillips Erb. She is a Philadelphia area senior writer and Forbes covering tax, law, and financial crimes. She's better known online as Tax Girl, so look her up as Tax Girl online. A tax attorney, she holds a JD and an LLM, tax from Temple, interned with the IRS Estate and Gift Tax Division, and is admitted to the Pennsylvania Bar and U.S. Tax Court. She reported on major cases including South Dakota versus Wayfair and U.S. versus Moore. Honors include PBJ 40 Under 40 and International Tax Review's Global Tax 50. She loves traveling with her family and helping taxpayers get and stay out of trouble. So we're so excited to welcome you here, Kelly. Thank you for being here. And thank you everyone for joining us. I'm going to go ahead and turn off my camera and you can take it away with the conversation.
Okay, awesome. So Kelly and I are basically doing a part two follow-up to our part one myth busting of the One Big Beautiful Bill. We're going to really niche down on this, and ultimately, employers are not going to get a pass for 2025. And my conversations with Kelly, our pre-calls, this call is all about guidance, the impact on the employer, and the importance of good record keeping. Everything is hinging on that because there is so little concrete information. There's few IRS agents. As Kelly said in her recent article, it's like the skinny, what did you say? It's not the skeleton crew, but
The skinnier version
the
of the
skinnier
IRS. Yeah.
version. Yeah. So you cannot afford to have, um, you know, you can't afford to have bad record keeping. You have to make sure that you file and file correctly the first time because, the amendments are going to take a few years. So, Kelly, let's start off by talking about the ACA credits. Those were not included in the One Big Beautiful Bill. For those of you who don't know, it's the Affordable Care Act. And there are 5 million business owners who rely on this, early retirees who aren't 65 and using Medicare yet, and sole proprietors. So it's affecting a lot of people. Kelly, do you want to share your thoughts on this?
Sure. So I think the idea of the premium tax credits is confusing to a lot of folks who have traditional insurance because it's just not something you grapple with. So in our country, we tie employment to healthcare. So it's really difficult to get healthcare insurance if you can't get it through your employer, right? So those people that you mentioned, in particular, small business owners and people who work for small businesses, and also folks who are aged out of because they've retired maybe from their company, but they're not yet qualifying for Medicare. They're in especially vulnerable because they're in the middle of this kind of this almost a dead man zone where it's difficult to get coverage. And so, as part of the Affordable Care Act way back when, the exchanges were created, and the exchanges were a place where folks who did not have access to traditional health insurance through their employer could go and buy coverage. And so, other people other than those groups that we mentioned also buy their health insurance through the marketplace. In fact, I know that some people buy it because it's cheaper than the plans that they have available to them. But there are some folks, again, those folks we mentioned in particular, small business owners, small business owner employees, and folks who have sort of either taken early retirement or not yet qualified for other government benefits. They are those who in particular take advantage. So when you talk about the millions of folks, they did do a study and they think this is going to impact at least 5 million business owners, for example, that rely on the marketplace for coverage. And so normally you would buy coverage and that would be the end of it, except that when you buy it through your employer, they've negotiated a rate, right? So for example, through if you're at Coca-Cola, Coca-Cola has negotiated a rate with their healthcare insurance provider so that everybody pays the same amount or they pay in tiers, right? So it doesn't get more expensive for you typically when you get older, for example. But if you do it through the marketplace, they look at a number of different factors. And one that's really important is your age, and the other is your income. And so you could actually be in a situation where your healthcare premiums are more expensive than you can afford, but you don't have another alternative. The healthcare insurance is what it is. So under ACA, there's these premium tax credits that sort of cap they exist to sort of cap the amount of your income that you would pay in premiums. So let's say, for example, and it usually is around 8.5%, but let's say 10 because those are easy math numbers. Let's say you made $60,000 and your premium, we've decided that your premium that you can afford is around 600 a month because that's at 10%. But when you go to get coverage, it's 1,200 or 1,300. So the amount that's different, you can have subsidized by the federal government if you meet certain criteria. And the reason that's important is because that's how you afford the coverage. And you can do it in a couple of different ways. But one of the ways that most people take advantage of the credit is when they file their tax returns in March, April of each year, they fill out an extra form where they report what their income was, whether they received the credits, and then they either have to pay back the extra or maybe they get a little more back. And what the big fight of the shutdown was about was whether or not to extend those credits because those credits were temporary. They've been renewed, but they haven't been renewed as of the end of 2025. And so that's when you hear people talking about ABA and why it matters. ABA did not include those tax credits. They were not extended. And so that was what the big fight was about after and the shutdown. And what the kind of the resolution on that is, and resolution is in quotes, resolution, is that the Congress agreed to talk about it again in the middle of December. So you may have seen in the news, the Senate Republicans are going to introduce an alternative plan. Democrats just want to push it through for 3 years. Initially, President Trump suggested he was on board with just extending the subsidies. He said that right before Thanksgiving. He's changed his mind a little bit on that and walked that back. So the very confusing resolution to all of this is that we don't know what's going to happen yet. So it's, end of the year is coming up. The credits are going to expire. We don't know what that means. It could mean premium increases in certain geographic areas in particular. Also for certain demographics like we talked about, in particularly seniors, because again, coverage is dependent on age. So the older you get, the more you pay. Those caps don't exist to push that back down. You could find yourself in a place where the coverage is unaffordable. So that's something I think we, especially as tax practitioners, need to be mindful of. I think there's going to be a lot of questions, as to what's going to happen coming forward. Do you qualify for the credits? Do you not? Some of the alternative plans would simply raise the income levels for qualification. Some of them suggested doing away with subsidies altogether, but just sending out a check to taxpayers. So it'll be really interesting to see what Congress is coming up with. So far, we don't know.
Yeah, and Kelly, you and I, have talked about this before, but I had an employee approach me yesterday and say, my husband no longer has his employment. We're paying $3,500 a month for Cobra. She shopped around health insurance. Her husband has pre-existing conditions. It's cheaper for her and her daughters to get private insurance and keep him on the marketplace, but
Mhm.
ultimately they're paying $1,600 for the family. So, who shoulders the burden? Well, then she comes to me as an employer who doesn't have 50 employees. I'm not required to carry insurance for my staff. That's a big cost. It's a big cost to shoulder. I want to do what's best for my employees, but this is the hinge point. This is the problem. I have a neighbor down the street. Her son has cancer and their premiums under the marketplace are 700 and she's being told they're going to go up to 2,800. So that uncertainty just creates so much turmoil. Prices are already high. I'm really hoping that this vote, comes out favorable. I don't foresee $1,000 check or a $2,000 check annually from the government as being a good solution. You said that's been thrown around because if premiums are $1,000 to $2,000 a month or 1,000 to 2,000 or 3,000 more than people are budgeting, that's going to be a really difficult hardship for families that they're not going to be able to afford. And a $2,000 annual payment won't touch those monthly
Right.
premiums.
And one of the things that the that the plan, when we mentioned the check, one of the things they had suggested was that those would land in HSAs. HSAs are health savings accounts. One of the interesting parts of the marketplace that we've seen is how it is dovetailed in with health savings accounts. And for folks who don't know, and this is my big pitch for why you should have a health savings account. HSAs were created to help you. It's incentivized. They're actually about 25, almost 25 years old now. But we're talking about them more as health insurance becomes a bigger issue. But they are health savings accounts that you can set up. Sometimes you can get a match from your employer, but if you don't have an employer sponsored HSA, you can still create your own HSA account, and they're tax favored. And basically, you toss some money in there if it's from your employer. If your employer has the plan, you can do pre-tax money. If something you've created on your own, it's post-tax money, but you can get a deduction on your return to make it all make sense at the end. But you save, the money grows tax favored rate, so it's tax deferred. It's almost like an IRA in that regard. And you take the money out to use it for qualified expenses. So you're using pre-tax dollars, which is advantageous. You can use it for all kinds of stuff. You cannot use it for premiums, but you can use it for all kinds of things. And the rules around HSAs keep changing as they become, I think, more popular. One of the reasons that they're popular in particular is because unlike an FSA, the flexible spending account, you don't lose it at the end. So if you change your employer, if you quit your job, if you just don't use the amount of money at all that year, you don't lose the money that's in it, and the account doesn't go away. It remains yours. So it's a great way to keep saving if you don't deplete it.
And you
I
can
will,
invest it. If you
I'm
don't
sorry.
use it, you can invest that money.
Yeah. So
And I don't know that people understand with a flexible savings account that it does change when you have a new employer and it does
yeah.
expire at the end of the year, most often. And so you have that triple tax deduction with the
Right,
HS.
and the investment thing is interesting because so I'm a mom, three kids. We go through our our HSA, but I do have friends that do not bleed through theirs like we do, and they do. You have the option of investing the money. I just always sort of kept it as cash because we ended up, yeah, again, depleting it every year. But you can, if you have money left over, throw it into stocks or other investments. So that's a great point. The IRS did just this week release some additional guidance on HSAs, which I'll just throw out there really quickly. It's
Please
not part
do.
of ABA, but still important. And so those three things are telehealth services. It was one of, during the pandemic, I think we all know that we saw that increase. There was a question of how that would work with an HSA. And so what Congress had done is say, yes, it can, but it was actually a renewal, like it was a temporary provision, and that's been made permanent. So telehealth services are now acceptable and they do not impact your HSA for qualification. So another thing that's changed with respect to HSAs under the new guidance that we just saw from IRS is there was some concern about whether certain kinds of plans, when they provided more than what the coverage is supposed to allow, whether or not that would disqualify you, which seems kind of wacky, but was actually a rule. So if you're familiar with the marketplace and you see bronze, gold, platinum, the different metal tiers, each tier you pay a certain amount, and then the government pays a certain amount. And so typically the bronze is the one that you hear most about, and that's the 60% plan. So the government would pay 60% of a bill and you would pay 40. Because you're paying more, the premium is lower. When the government pays more, your premium goes up, right? So if you're in the top one. And the way that the HSA rules were written was if a plan that you bought, let's say off exchange, was the equivalent of like a bronze plan and it gave you more coverage than you're supposed to get, it would actually disqualify you for HSA reasons, which again, kind of crazy, but was the way the rule was written. And this actually came to light in particular in certain Native communities because there are health plans in Alaska in particular that did have like a little incentive. So you would get a bronze plan, but you'd get a little more, and it would have been disqualifying. The HSA guidance says that's no longer the case. Also, if you buy a plan off exchange that you thought was the equivalent of like a bronze plan, which is sort of the baseline for the HSA, and it turns out that you were wrong, IRS says, as long as you believed you were right, we're going to allow it, right? And so the third thing that is really interesting is if you've seen these increases in direct payment arrangements, it's almost like a subscription model for a GP. So you pay your doctor $25 a month for certain kinds of services, or the number can be higher. It was really interesting because the HSAs didn't know how to handle those. In fact, they were considered initially disqualifying because it was considered an alternative payment arrangement, which wouldn't fly under the rules as written. But that ended up changing as well. So IRS now says these kind of arrangements, as long as they tick the right boxes, are still allowable with an HSA. So I think we're going to see more conversations about healthcare in the next couple of months as we talk about escalating premiums. And again, kind of hinges on what Congress says. But I think it's really important in particular for small business owners and for practitioners to understand the alternatives that are available. Because even like you mentioned, maybe you can't provide insurance for all of your employees, but you could contribute to an HSA on their behalf, right? So as
Right.
long as they were to meet the requirements, you could say, you know what, $500 to everybody for their HSA. And if you do it right, it's not taxable to the employee. So there's a lot of, I think, options that we're going to start hearing about, some creative options people are coming up with all the time in ways to kind of address the escalating costs of both premiums and healthcare. So definitely worth keeping abreast of those.
Yeah, I'm excited to see what happens in the next week or two.
Yeah.
Uh, there are a lot of things that we've got to get ironed out and over. The shutdown lasted way too long, all the uncertainty with that. I think people just in general feel too much uncertainty and their
Yes.
budget is number one. So Kelly, let's talk about the new tax rules under the One Big Beautiful Bill, ABA, the overtime, tips, seniors, and phase outs. We covered this in the first webinar that we did, but let me just summarize really quickly. The overtime is a deduction. It's 12,500 singly, 25,000 married filing jointly. There are income limits of 150 and 300,000 respectively. Something that I just want to make sure that employers know is just because you pay somebody overtime, you are still paying FICA and the employee is still paying FICA. And I hope that we can really drill that, um, so that people understand that that's a really big deal. You're going to save on federal income tax. Not all states are willing to do a state income tax. There are just a couple. So your employees are also not going to see that state income tax deduction that they're thinking that they might get. I also want to just make sure that people understand that on a W-2, it's not going to be effective for 2025, but going forward, it will be. There will be a box for overtime. Now, with that being said, it is only on that extra half time that will be reported in that box. So, if you're paying somebody $10 an hour and they work overtime, they're getting paid $15 an hour. I have a payroll company. I am assuming most people will think, oh, all $15 of that per hour will go in that income box on the W-2. That is not the case. It will just be the extra $5 that half time. And that is where the savings is. And so, if somebody accrues, you pay them $150 of overtime, make sure that you're actually really only reporting that $50, and that is where they're going to get the overtime deduction on the federal income tax.
And I
Um,
think one of the things that's also worth mentioning, since you mentioned the premium, is that a lot of the conversation around this has been how much overtime are you being paid? But that's actually not the way the law is written. It is, as you mentioned, the premium, and it's the premium according to the federal laws, right? So the Federal Labor Standards Act. So, which only provides for that 50% that you mentioned. So the 50%. So if you're a great employer and you say to your folks, you know what? I appreciate you for overtime, for working overtime. I'm going to pay you twice as much. That's awesome, but still only the portion that 50% that premium is the only thing that remains deductible, even if you pay them more. So that's really
love
important.
it.
I,
That's
I've
good
heard,
clarifying.
yeah, I've heard a lot of folks talking about, well, this is great because I get double time. Well,
Yep.
super. But the only part that's going to be includable in the deduction is the 50% premium under the Fair Labor Standards Act. So really important for
Yes.
employers and employees to know.
And it's not like the employers are saving anything. It's the employee that will capture that federal income tax deduction.
Right.
And the income phase out is in dollar increments.
Mhm.
It matters. We haven't talked yet about tips. Tips is also a phase out in dollars. The senior deduction is going to be a percentage. And so, Kelly and I talked about how whoever wrote this, it was not the same person
Yes.
because there's discrepancies and changes and, that fine print, and it's not the same across the board. And so, another thing we're going to talk about more about AI, but you might chat GPT this and it's not going to give you the right information. So it's
That is
really
that is
important.
important.
Yeah, it's really important. I mean, I had an accounting firm in Utah say, we're providing meals for our staff. And technically, under the One Big Beautiful bill, it says you cannot deduct that. Um, that's no longer a deduction. And they
Except for
didn't know that.
holiday parties. Holiday parties remain deductible, so I highly recommend you throw holiday parties. But
There you
yeah,
go.
yeah, there's
Yeah,
some.
change the way you're doing things. But if you chat GPT, can I bring in meals for staff? It will say yes, and you can deduct that because it's necessary. But on the One Big Beautiful bill, it is not deductible. And so I think it's important that
And
you
I think that's a really good point generally about ChatGPT and who's going to lean on who, because especially something like I keep saying that the rules are the ones that are under the Fair Labor Standards Act, right? But who knows those off the top of their head? Like I'm a tax attorney and I can't cite that. That's a labor law, right? And it's specific. It's Section 7, right? So like who knows that? So I do think a lot of people are going to go to Google, and they're also going to go to ChatGPT. And again, we could talk about this more at the end, but I think one of the things that I really want to stress is that this is why people are going to lean on their tax practitioners, right, during tax season, because you want to make sure that you have the right answer. And one of the things that you miss when you do ChatGPT, and again, I'm a fan of AI. I'm not suggesting that they don't can't be a good tool, and we're going to talk about that toward the end. But keep in mind that you need context for those things, right? And sometimes that context isn't there. So don't be scared to pick up the phone and talk to your tax person, or make sure that you're subscribing to either a service or a newsletter or something that's going
follow
to
Kelly's tax advice on LinkedIn.
exactly.
That's the
That's going to be updating you as this guidance comes out. Because again, literally guidance keeps coming out. One of the things on an overtime, for example, since you mentioned that the boxes aren't going to be there for the first filing season, right? They're not redesigning the W-2 for 2025. The IRS did release guidance for both employees and employers about how they should treat overtime. And it kind of keeps coming back to keep good records. And we're going to hear this a lot, but the IRS is kind of taking a loosey-goosey approach to 2025. They're more or less saying do your best, right? So for
That's probably
reporting,
because they're understaffed too, Kelly.
I
That
know,
they
I
don't
know. So
provide,
so
those concrete guidelines.
Right. So when you're seeing like overtime, when you're seeing tax on tips, when you're seeing a lot of these the guidance that's coming out, IRS is giving you some guidance, but then they're qualifying it with again, kind of do your best, like make information available. We're really going to see changes though in reporting in 2026, which is funny because we keep talking about it like it's really, really, really far away. It's a couple weeks, right? So just be thoughtful about the fact that even though we're saying right now, do your best is not going to be quite good enough in 2026. You're going to have to follow some rules that we don't have completely under our belts yet.
Yeah, and just to clarify, there's different definitions of overtime based on your state, and the rules might be different for overtime. So if you have employees in multiple states, make sure that you understand what those are and what qualifies.
Mhm.
Um,
Payroll companies, I would heavily recommend payroll companies. I think that
yeah,
small businesses don't lean on those enough.
I agree with you. I had my uncle call me and say, Jenny, I'm getting pushed out of desktop. QuickBooks Desktop. And I'm thinking, how are you still using that? I don't even know. And he's doing the filings by hand. And I said, Uncle Sid, you have got to get on board. It will save you so much time. And within payroll, I talked to my payroll specialist to just see, how are you reporting this? And there is a way to differentiate pay wages. And when you add an employee, you can say, yes, they are entitled to overtime. This is the maximum that they're entitled to. And then when the employer goes to enter payroll, they can differentiate if it was, such and such. But I'm still interested to see when the payroll, generates those W-2s, is it doing it correctly? Is it only on that 50%? Because it should only be on that. So
Yeah.
we'll see.
And I will just add two more quick things about the payroll tax. Just one is when I started my own business years ago, we did not have a payroll tax company in the beginning. We were doing it all ourselves. And I mistakenly believed that payroll tax providers were crazy expensive. Like in my head, I thought it was something only big companies used. So for our small law firm, I thought it would be cost prohibitive. I would urge people to do some research, call a few people, ask them. You'd be shocked, I think, at how relatively expensive it is.
Yeah.
Which I think is great. And then I will also say, since we talk about the fact that I'm a tax attorney, a lot of the folks that I help in small businesses in particular are folks who are in trouble, right? So they don't usually call their tax attorney when they are seeking planning advice. They tend to call when they've gotten into a jam. And one of the top mistakes I see with small businesses is not getting payroll correct, not having a separate account, not paying it on time over to the IRS. So I think that, this is a really good time because the rules are changing and they're complicated. If you've been struggling with is it worth it? I would highly recommend you to, 2026 to me is the year to make that change. Call a payroll company, let them set
Tell
up a
me, I
separate.
have a payroll company and I will be cheaper than anyone.
Yeah.
Um,
I just think it's super important. And I
it
think,
is
again, I
super
think
important.
people don't think about it because it feels like a big lift and it's not.
Yeah, I have a client who was not appropriately paying his employees. He was paying a lot of them in cash. And I always say the wheels of the IRS turn slowly, but they turn. And it was years later, probably 7 or 8 years later, there were certain audit flags that came up. He lost his house. He, now instead of paying 300,000 in penalties or the FICA that he hasn't paid, he's double and tripled in penalties and interest. And it's catastrophic, especially when, you're wanting to retire at some point. So it's just better to pay a little
Mhm.
bit and have it
Yep.
done upfront. And I have seen that the amount of time that you're hiring an employee to do that footwork, it's much cheaper to just pay the software.
Yeah.
So, um,
And as you mentioned, what if I'm in the Northeast, we have Pennsylvania, Delaware, New Jersey, New York, all really kind of close together. It's not unusual at all for somebody to have a business, even a small business where they have employees in different states. It complicates matters. So 100% pro
yeah,
payroll. And
I
again,
agree with
since we're
you.
talking about, and we're about to talk about the tips deduction, but since we're talking about these things that impact pay, 2026 is just such a great year to get started in that.
Yeah, for sure. Yeah, you have a few weeks to get ahead of that.
Mhm.
The tips deduction is from 2025 to 2028. It's 25,000 maximum per return, not per taxpayer. So if you're married and filing jointly, in my opinion, that's a benefit. One person might be making more tips, but you can have up to 25,000. Unfortunately, if you're both making tips, again, that is combined per return, not per taxpayer. So be aware of that. And the phase out, again, is based on a dollar amount. So there's a 10% reduction for every $1,000 over the limit. So if you make over 150,000 filing single or 300 filing jointly, there will be a $100 reduction for each $1,000. So make sure that the tips are reported correctly. There are benefits to paying tips and credit cards. The employers are often able to know exactly how much is paid in tips. Cash makes things more complicated. Kelly, do you want to share your experience with the beauty salon and the income that's
Sure.
it appears that you're making more income, but a lot of that is tips and the benefits not really going to the employer.
So I believe, so two things. One, I believe that a lot of employees who receive tips actually do report them. I think that we talk about this as if they're not reporting them. I think the mechanisms for helping them figure out how much to report have been short, right, for a while, but now we do have more POS, right, with credit cards. So I do think that we're going to see it becoming easier to report tips. But there are non-tax advantages to reporting tips that I think sometimes get lost. And as you mentioned, I actually talked to a salon owner, I believe it was out of Nashville, and she actually puts on education workshops for her employees to let them know not only the benefits of reporting their tips, but also helping them learn how to invest and other strategies. But one of the things that I think people forget is that, we all want our taxable income to be super low, right? Because we don't want to pay taxes. But if you don't hit certain thresholds, that means when you go to get an apartment, when you go to get a credit card, when you go to a bank to try to get a mortgage,
Or
the
you go to
bank,
sell your business and you've
yeah,
underreported your income, that's going to bite you when there's a
right.
multiplier.
But the bank doesn't want to hear, yes, you reported 20,000 on your tax return, but you actually made 40, right?
Right.
Like they want to see what's on the W-2. So reporting your tips, especially if you can benefit from the deduction, that's going to mean that you don't pay tax on them on the income tax side. Again, FICA and state, as we talked about before, and local still apply, but you're able to reduce your taxable income, but you still have a W-2 that shows a bank or a landlord or a potential business loan person that you were making more money, which I think is super important. The reason I mention hairdressers in particular is because for many, many years, there was something called the FICA tip credit, which is Section 45B. And it was applicable only to restaurants and food providers. And what the FICA tip credit was is when you add up, let's say you had a $100 meal, you put a $25 tip on it, the owner of the restaurant never gets that $25, right? Like that money is earmarked for the employee,
Right.
but the employer has to pay FICA on that entire portion. And restaurant owners didn't love that because a lot of the compensation that was being paid out, which again never passed through their systems, they were required to pay FICA on. So the restaurant industry had what was called a FICA tip credit for many years, where the IRS says, okay, we're going to let you basically offset the part that you didn't really get that, but you had to pay FICA on. Which was great for restaurant owners, not so great for other
I mean,
service
Kelly, does
businesses.
this make sense though? Because if it is that the majority of their wages are tips,
Mhm.
I can understand why the government is saying you should pay FICA on that because that's
Well, the
essentially,
employee eventually pays FICA on it, but the
yeah,
employer doesn't pay the match. So it's almost, I mean, for
but
reporting purposes, it's almost like they're self-employed, but they're not. I mean, I'm not trying to imply
right.
that they are, but that's how, yeah.
But do you know what I'm saying? Like, I think a lot of business owners, especially when this no tax on tips came out, they were saying, hey, you can be a tipped employee. We'll pay you
Mhm.
we'll convert a lot of our wages to tips. But does that not seem
So
like
they
the
still, so
employer
those
is trying
folks,
to get
if
out
you're
of the FICA?
if you're not a restaurant owner, you still have to pay the FICA on those tips. So you only get the tip credit if you're a restaurant owner,
But
or
why just restaurants?
well, because they have a really good lobby. And for
Right, there
years,
you go.
the beauty salon industry actually lobbied to be included, and they were not. But in ABBA, they finally are. So now salon owners, spa owners, barbershop owners, they all also get the benefit of the FICA tip credit. So it's really important for business owners to know, again, do they qualify, do they not? Because it could be a potential savings for business owners, and it's really important. To your point about, a lot of folks kind of redesigning how they compensate employees to kind of shoehorn into this tips category, I would stress one of the things I think keeps getting lost that these are temporary deductions, right? So this is not forever. If you decide today that you're going to consider your employees to be tipped employees so that they can take advantage of a deduction, that's super. But what happens when the law changes after 2028? So I would encourage small businesses in particular, before they make any significant changes to the way they treat their employees for overtime or for tips, to have a chat with their tax professional and their lawyer and see what the long-term ramifications of that are.
Right.
Because if you change the way, for example, you compensate your employees for purposes of overtime, and you have a rule all of a sudden that everybody gets overtime, which I have seen people on social media say this year, all of my employees are going to get overtime because they're thinking that they're providing this tax-free
Exactly.
benefit. Do you walk that back when this is no longer a deduction? So just be thoughtful before you make any large, significant changes in the way that you compensate your employees, and be sure to talk to your tax folks in advance to make sure that you don't, back yourself into a corner and then
Yeah,
have
because
people
a
angry.
lot of people do back themselves into the corner. And then when COVID hits and the PPP tax credits
Mhm.
happen, or there's, benefits, if you can retain your employees, you have to be able to show that you're paying your employees. So
Right,
people shift their reporting, and then there's disadvantages down the road.
right.
And
So
you don't
again,
know
I
what
think
those are.
2026 is just such a great year to get compliant, to make sure that you have a great business strategy, that you're having conversations with your employees about compensation, how they want to be compensated, and what you feel comfortable compensating with them with, because maybe you decide you don't want to pay overtime.
Right.
You and I have talked about outliers before. Sometimes too much overtime is a flag that you need to hire more people instead, right? So
That's
again,
exactly what it is to me, Kelly. It's if I'm looking at somebody's financials and their payroll is gradually increasing, but their gross revenue is not, to
mhm,
me, that's a flag that something's wrong in payroll. And
right,
often it is overtime. And that should be a flag to hire more people,
mhm,
because that's an additional expense that's unnecessary.
yeah,
If it's temporary, that's one thing. If there's a push, because there are costs for training and adding new staff and administration fees to oversee them. So I'm
right,
not saying always if there's overtime, it should flag a new hire. But generally speaking, I would say probably 85-90% of the time, if payroll is increasing and you consistently are having overtime, you should be hiring more people, because long term, it's going to be more beneficial to have more staff to support your growing business than to be continually paying overtime, for sure.
right. And I want to just add one more thing about the tips. We did get some guidance again from IRS on tips as well. And again, sort of a do your best kind of scenario. Some tips are reported already on tax information forms like W-2s or 1099s, but there might be some that isn't separately broken out. So you just need to be thoughtful about that, especially if you're not set up that way. So you want to be thoughtful, and also make sure that you qualify. The Treasury did put out the list of traditionally tipped occupations. Those have to be
Right.
those occupations were ones that were traditionally tipped before December 31st, 2024. And they're on this list. And the first kind of version of the list was complicated for a lot of reasons, because there's also certain exclusions under the law, including SSTBs, which we're not going to really have time to jump into right now. But generally, those are your Section 199A exclusions, the same small business owners that would not qualify for that, including lawyers, accountants. They also didn't make the list, but then it was a little confusing because the definition of an SSTB is usually one that relies on the expertise, knowledge, or reputation of the owner to promote the business, which is why, again, accountants, attorneys, that kind of thing. But then when we saw the list, there were certain things like content creator was on the list. Well, if content creator isn't that somebody who relies, you're relying on their expertise or reputation. So the IRS knows it has some work to do. It did acknowledge that they're going to be putting out anti-abuse regulations, and we've already seen some tweaks once the list came out. A few lawmakers raised some concerns about the fact that certain kinds of websites would be eligible to qualify for the deduction. Specifically, porn was one that people were really unhappy about. And so that's actually was in the guidance that and they didn't really tell us what porn is. So I guess we're going to wait and see. But if it involves certain kinds of activities, including illicit activities, but also porn, it would not be eligible for the tip list. So it'll be kind of, I think, interesting to see what kind of arguments and creative solutions people come up with to make sure that they're on the list.
Yeah, and again, guidance to employers because this is for employers. If
Mhm.
you have an industry that is not typically tipped or have overtime, don't all of a sudden pivot to try to give that
Yeah.
small federal income tax deduction for your employees because you will end up getting in trouble. It will raise an audit flag. And my article with Kelly, we've done quite a few pieces together, but Google our article on outliers
Mhm.
and small business owners can kind of look at those, but you don't want to be that outlier. And if you're in an industry that it does not typically have those deductions, it will flag an audit. And it may not be fast, but the wheels of the IRS turn. So you just
Yeah.
don't want to be caught.
Well, and I think this is a good point to talk about reporting because one of the things I've heard over and over is so we talk about skinnier IRS. One of the things I've heard over and over is what are the chances I'll get caught, right? Like there are fewer IRS people, if you're going to cheat, cheat now, right? Like that's a lot of what you're hearing come
You just
out
act
of.
like you have no idea and you're innocent and you didn't have
Right.
proper guidance.
So, but one of the things I think gets lost in some of these discussions about the skinnier IRS is that the IRS is increasingly using, we mentioned AI earlier, they're increasingly using AI algorithms, certain kinds of technology to help them do their
Right.
job. And so there's something, we all kind of joke about low hanging fruit. The IRS is still going to be able to go after the low hanging fruit. And as you mentioned, if your company does something a certain way for 10 years and then for 3 years does something different, that does not mean you're doing anything wrong. It may mean, however, that the IRS sees it as an outlier, right? And so they may ask you questions. And I always used to joke that you never want to be in the maybe pile, right? Like you don't
Right.
want that call from the service. So I think it's really, don't get lost in this idea that a smaller, skinnier IRS is necessarily going to mean less enforcement. I think it's going to mean less enforcement for very sophisticated kinds of tax moves. So we might see less people offshore being chased because that's harder information to have. But
Mhm.
you're providing information you have been for years to the IRS that's in their system. They have the data. They can look at those algorithms. And again, yes, businesses get bigger, they get smaller. Things happen all of the time,
Right.
but they're going to be looking, I think, for some patterns. And as you mentioned, that might not be the phone call that you get in 2026, but it might be the phone call you get in 2028. So just be
And
smart.
you're going to end up, you just need to remember that your penalties and interest will be much greater.
Mhm.
So only make these moves if it's reasonable, if it's assumed, if you're looking at the guidance and then do it. But
Yeah.
otherwise, don't be chasing all of this unnecessary stuff if it's jeopardizing your
Well, I always say, don't let the tax tail wag the dog, right? Like you
Yes.
don't want to be chasing down the deduction at the expense of your business.
Yeah. Shannon, are we out of time? Is that why I see you again? Do we need to quickly wrap up?
Yes, we are running low on time. This has been a great conversation. But yes, if you'd like to add your final statements, then that would be awesome.
Okay. Um, I was just going to point out with the senior deduction that phase out is a percentage. We didn't have a chance to talk about that, but whereas the tips and overtime were dollar, that is a percentage. And really everything is about good record keeping. So make sure you have good record keeping, make sure you can defend yourself. The burden is on the employers, not on the employees. And, Kelly, do you want to do a quick summary of the 1099s? I'm going to make one more point about automobile interest. If you were to
Mhm.
chat GPT this, it will say you cannot deduct um, interest on automobiles. However, on the one big beautiful bill, You can if it's a new car, if it's leased, if it's assembled in the US. Again, I think people may not know that, but it's only for personal, it's not for business. So, as a business, don't go buy a new car that's been assembled in the US thinking you can have that interest deduction. There is not a spot for a 1099 interest statement. So, keep good statements of that so that you can justify what you have paid in interest on a new loan. It's not a lease. Kelly, do you want to quickly summarize the 1099 updates?
Sure. I actually think that this is one of those areas that has gotten just way too little attention, and it really does impact business owners in particular. For years, we've been stuck at this $600 threshold, right, for 1099 MISC and 1099 NEC. That threshold has actually been increased to $2,000. Still, I suspect a lot of people are going to think it's a little low, but that it has been booted up. So for issuing those returns, where that gets a little fuzzy, I think for taxpayers, and something we need to remember is just because the reporting thresholds are different doesn't mean that your own personal reporting threshold is different. IRS requires you to report income at $1. If you don't get a 1099, that doesn't mean you don't have to report it. So if you make $1,000 and you don't get a 1099 because you're under the 2,000, but you normally would have gotten it because it was over that 600, you still need to report it. So I think that's really important. The other thing, people were really worried that we were going to see an onslaught of Forms 1099-Ks. Those are the forms from the payment platform reporting. So your Zelle, your PayPal, your
Venmo.
Venmo, and also credit cards. But the credit cards pay no matter what. But the payment platforms were actually subject to a threshold. Under ARPA, they had changed it, and it was going to lower it actually. And under ABA, so the most recent tax law, they've changed it so it's kind of an everything old is new again type philosophy. So it's as if the 2021 changes that were proposed never happened at all, and we're back to the old 1099-K reporting requirements. I know there was a lot of nerves about whether next year you were going to get tons and tons of those Forms 1099-K. You may still, because people had it in their systems, right? So if they were working up to it, you may still get them, but they're not required to send them to you. And the IRS has issued some guidance on their website, and also how to make annotations if they're wrong, because 1099-Ks are supposed to report business, but what if you had an Etsy platform and you mix business with pleasure, right? So, there's going to be, I think, again, a lot of tweaks and adjustments that we're going to find ourselves doing.
And just really fast, I would just make sure we reiterate that practitioners should not think I'm going to file now and fix later.
Mhm.
Because of the staffing issues at the IRS, it's important that you have the accuracy the first time.
Yes.
Probably don't be filing based on pay stubs. Wait for the
Mhm.
W-2s.
Yep.
And, with the shutdown and staffing issues, there will be longer processing times, especially for amended returns and slower resolution of disputes as well.
And I'll just also mention, since we've talked a lot about the guidance, the IRS is doing, I would say, an honorable job of trying to push out guidance. But there is a skinnier IRS. We did have 43 days of a government shutdown
Yeah.
post ABA. And, the filing season was also coming. So they had to prepare for the filing season, right? So that's going to be in about a month and a half. It's going to open, most likely, knock wood. And so guidance that's coming out, you'll see a lot of guidance that isn't the kind of guidance that we're used to seeing. So the other day, for example, on the Trump accounts, we got something that was a notice, like an intent to provide notice. It wasn't proposed regs. We're seeing this in a lot of arenas. So just be thoughtful when you see the guidance that it may not be complete. I fully expect that as tax season rolls on, or begins and then rolls on, that we are going to see more and more guidance. And also keep in mind that guidance, especially FAQs on the IRS website,
Yeah.
is just guidance. It's actually not law. If it's not on in the federal bulletin as a published reg, you can't really rely on it. And IRS is sort of understanding this, has said some things like, if you make a mistake, we'll give you some grace as long as you can point to something. But still, once you've made the mistake, as you pointed out before, that now you're in the audit cycle, right? So like, just be thoughtful. Don't rush into things. Rely on your practitioners for help. And again, don't rely on just something you've seen on the web, even if it's from IRS, if it's not actual regs, if it's just guidance and notice. It's think of them as guardrails, right? Like, you don't want to be skeeting, kind of skeeting down the side of the guardrail. You want to be firmly in the middle. It's better if you have the great guidance, but worst case scenario, at least you have the
Yeah,
guardrail.
love it. Thanks, Kelly.
Yeah, thank you. This has been a great discussion. We have a few questions from our live audience. So this is a question for Jenny as an employer. Would you say it's a good move for an employee at a small business to see what the employer could help with? Are stipends towards health insurance a tax benefit to employers, even if they aren't able to do group health insurance? What do you think?
Dinner with the CEO of a health insurance company, and he said, "Do not start offering health insurance if you have less than 50 employees because it just opens this Pandora's box, and it's so expensive." Um,
So
and
I'm
like,
gonna I'm gonna disagree with you on the one hand though. So it is very expensive. I agree because again, as a small business owner, but I think that when you said you talk to somebody at a company,
he's the
I
CEO of a health
I
insurance
would
company.
highly recommend working with a broker because a
Yes.
broker for a small business can tell you, like, it doesn't hurt you to call them and say, what are my options? Because you may not need to offer your employees the ability to opt into a plan may not require you to have to pay for the plan, right? It may be
Yes.
that you can just give them better coverage. They might be able to go to a small business plan that you pick up as the employer and then they make contributions. And we all do that in our normal, if you're working for a bigger company. So I agree with you that I wouldn't want to be on the hook full time
Right.
for a lot of employees if I wasn't sure, especially in this economic climate. Like, I don't know that now is the time to jump into that when we're not sure what premiums are going to look like
Right.
next year, for example. But highly recommend if you're thinking about it, call up
To
a
shop
health
it out.
insurance broker and say, like, help me figure out what are my options, how much will they cost me, and how much will it cost my employees.
Yeah, I agree with you. And sometimes offering those benefits, people will take a little less pay because they're getting incredible benefits or some benefits. So there's the point from retention. Obviously, from a tax standpoint, you can deduct those are going to be expenses for your business. So it's not like I wouldn't say it's gonna make you pay more in taxes. You'll have that deduction, but I think it is helpful for employee retention. My husband offers an amount per employee to put towards a plan. And I liked your idea, Kelly, of saying, put it towards an HSA. It may not go towards premiums, but that's something. So I think it's always a good move to offer more benefits to your employees.
Agreed.
That's great. So this question is for Kelly. What outside of holiday parties can a business owner deduct for employees that would benefit employees and the culture of the company?
Well, there's so many things actually that you can do. I mentioned one earlier that there was the health salon owner. Sorry, the beauty salon owner. She offered free education for her employees throughout the year. So they did like, on I don't know, a Thursday night, they would have somebody come in and talk to them about how do you get a mortgage? How do you invest? What's an ETF? That's a real benefit because especially for some really large businesses offer this constantly, right? Like, let me introduce you to your personal advisor who's going to help you figure out how to fund your IRA. A small business maybe doesn't have that the resources to have that kind of personal attention, but could have somebody to come in and talk to their employees about it. So I think that's really smart. Anything that you can fund that would be deductible, we mentioned HSAs, but anything like that where you can help your employees out and still get the benefit of the deduction, I think is smart.
I offer a
Especially,
401k match for my
Mhm.
employees. Even
Yes,
if they're
same.
part-time, if they've hit 1,000 hours, they qualify. I think that's a really great.
And with 401ks, there's actually a really great thing that the IRS allows now where there used to be this very hard and fast rule that you could only get a match for money that you contributed to your 401k. That made it very difficult for small, younger employees in particular that were trying to pay off student loan debt to qualify, because you're always in your head thinking like, do I pay more towards my student loan or do I put money aside for retirement? And under the rules now, you can, the employee can match, or sorry, the employer can match your student loan payments. There's criteria, but if you opt to
Yeah.
pay your student loan instead of contributing to a retirement plan, and if the criteria, if you get it set up correctly, the employee can actually, sorry, the employer can actually match that money in your 401k. So you're still getting the benefit of that. I
That's
think there's a lot of those little kinds of things that you can do for your employees on a pretty regular basis that, yes, it's money out of pocket, but there's a tax benefit to both of you for doing it.
well, and Kelly, we talked about how you can't deduct, um, your fees to the country club or entertainment under the one big beautiful bill. Still, it was before that, but you can't deduct that. You can deduct 50% of meals if they're necessary and it's not too excessive, but you can't deduct just these, I'm just going to wine and dine my clients or go golfing or go to a concert. However, you could perhaps give a donation to a football team as a marketing expense or as advertising, and perhaps they could give you tickets. So there's other ways that rather than classifying that or recording it as entertainment, you could do it in a different way that could still benefit the culture and the employees and give you the deduction. You might have to
Right.
be more creative, might have to hire a professional to help you, but it would be worth it.
Great tips. Yeah, thank you. So this question is about risk tolerance. So either of you want to jump in? So what's the right level of risk tolerance when taking a position or on deductions today where the IRS isn't giving super clear guidance? What do you think?
Well, I think it has to be defensible, right? Any position that you take, you can't just say, I'm going to throw this up and see what happens. So it has to be defensible. If it fits within the statute, and you feel like you can rely on it, I think then it kind of goes back to your own personal level of risk, right? I have business owners that never want to get a call from IRS. I have others that would say, you know what, there's a certain amount of risk I'm willing to take. Now, the risk still has to make sense. It still has to be defensible. It can't just be, I saw this on ChatGPT or my friend told me about it. Like you have to be able to look at the
I saw
statute.
it on TikTok, therefore
Yeah,
I'm deducting this, and it's
exactly. You still have to be able to look at the guidance, and you still have to be able to look at the information that you have, and it has to make sense. It has to meet the ordinary and necessary if it's a business expense. Like you still have to tick all the boxes. But in terms of risk level, what's acceptable, I think generally, as much as I kind of joke about the guidance, because there has been some guidance that's had to be changed because it was not either clear or it was not good. A perfect example is that the tax rates that came out, the adjusted inflation tax rates that came out for 2026. I remember when I was reading the rev, I was like, these don't look right to me. There were a couple that kind of jumped out at me as they didn't look right. And sure enough, and I actually emailed IRS. I'm like, I don't think all these are right. And sure enough, they did release updated guidance where they corrected their numbers. So, I think that they're doing the best they can under the circumstances. But I think one of the things you need to do is if you're relying on the guidance, keep relying on guidance, like keep checking because things could change. Make sure that you understand the guidance. I've mentioned before the Roth catch-up rules were not terribly clear. A lot of folks got them wrong. I was one of them in the beginning. And that had to be corrected. We've seen that quite a bit. So, I think you can have some level of comfort on, obviously with regs, yes, but when you're looking at something else, when you're looking at guidance that's not yet a reg, you can have some level of confidence if you interpret it in a reasonable manner, right? I think that when Jenny was talking about being creative, that's when your risk goes up. Because the more creative you are, the more you have to be able to find
just
that it's defensible.
And
Yeah.
and I think that's why you rely on professionals. If I came to Kelly and
Mhm.
said, "How do you feel about X, Y, and Z?" If somebody came to me and said, "How do you feel about me deducting this?" or "How can I classify this?" or "What deductions are you familiar with that I'm not?" That's why you hire professionals, and that's why they save you money. We
Mhm.
all pay taxes. We don't want to pay any more than we're required to. And so I think that, it would be misguided to just say, I'm not going to deduct anything to have zero, risk. So I think there is a balance and like Kelly said, it's individually based. I may have more risk tolerance than someone else, but make sure you have a savings account and make sure you're relying on professionals. And I think it's worth it to pay people. I think you end up with way more deductions when you have good guidance.
Agreed.
Yeah, thank you. Last question. Is QuickBooks updated for all of these changes, or is it dangerous to rely on QuickBooks?
I think it would be better to rely on QuickBooks than you trying to figure out the guidance. I would assume that QuickBooks will make sure that they're compliant and they're following the latest regulations. So I think it's fine to rely on them.
I would agree with that with a quick caveat that I think you need to be thoughtful about the timing because there may be certain software companies that are waiting to see if we get
Yeah.
additional guidance. So just be smart when if don't be planning for your 2025 year before the year is over, right? Like you might be doing some planning, but I wouldn't finalize anything before the year is over. And that goes back to the same things we were talking about before. Wait for the tax forms to come out, wait for more
You
guidance to come
file
out.
based on a
Yeah, I think we're going to see a lot more information from
stuff.
IRS in the next few weeks.
Yeah, and maybe do a quick audit. Like for me, I don't pay overtime. I don't think I have paid overtime, but if you have, perhaps you could just look at one employee and see what the W-2 looks like. Just do a random audit and see how
Yep.
that looks. And if you're unsure, call a professional like me or call QuickBooks, or call Intuit and dive deep into that. But yeah, don't file based on your last pay stub. Wait for the softwares to be updated. I think there's still some uncertainty until the end of the month, so hopefully that's clarified.
Yeah.
Great. Well, thank you. These have been outstanding questions, and it's been an excellent discussion. So let us know how we can find you online. So let's go to Jenny and then Kelly.
I'm on LinkedIn at Jenny Groberg and same on Instagram.
Great. What about you, Kelly?
And you can find me almost anywhere, including LinkedIn at Tax Girl.
Okay, great. Well, thanks everyone for joining us. If you are joining us live or watching the replay, we appreciate you. And if you have any questions, please reach out to Jenny or Kelly, and we hope to see you again soon. Have a wonderful day. Take care, everyone. Bye-bye.
Thanks, Kelly. Appreciate your time.
Thank
Thank
you.
you.